JBlog, 19th of December 2010. Today I'll start out by looking at the S&P 500's P/E ratio. It is at a new high of 2271, new high for this particular since 2009. It has been increasing, and of course that goes against the historical mean of 1638 and the median of 1576, with a minimum of 4.78 and a maximum of 44.20. That was put in December of 1999. Things that I keep an eye on are one of them is the TED spread. TED spread is what banks charge each other in interest when they lend money to each other. Basically, it says how much banks trust each other's balance sheet. It has been slowly ticking up again since it came down since September. There's a slow tick up there. Another thing that is interesting to look at is the Baltic Dry Index, which is shipping costs. How much does it cost to actually ship goods? It has been dropping down. The theory here is that there isn't as many items being shipped, that's bulk items, being shipped as there was back in October and November. And that of course puts in doubt how much goods are actually being made. Going right along, there's a few things that I am also currently looking at. Oil is currently at a high. There's potentially, obviously it's based on consumption, but there's potentially also a risk, a premium there. People continue to worry about the Middle East. Nothing particularly new here, but we could be looking at a drop down to 1991 and still be within this channel. And there's a bit of technical divergence going on here where the trend is starting to weaken a little bit. So we could very well be looking at a bit of a drop here. Oil will still be on schedule. Natural gas hasn't been as strong as I thought it would be. Even though I do see an inverted head and shoulders here potentially, but this drop Thursday and Friday was definitely an important drop, and I'll definitely keep an eye on that. I still do think that natural gas will be more expensive in the future. Um, Now, one thing I did spend a little bit of time looking at gold. I expected the gold price to come down a little bit. It has not so far come down. Um, but I drew a trend line right here, and what I have on that other trend line, now that's a nice trend line, higher highs, higher lows, and it all looks very good if you just look at the chart. But if you do look at the technicals, the RSI is starting to decrease, so you've got RSI highs coming in lower, even though the price highs are still going up. So that's a technical divergence, which is potentially flagging a reversal. We've got the same thing in the MACD. We've got the same thing here in the stochastics, and we have the same thing here in the tricks. So these are a few indicators to say that even though this rally is still showing higher highs, on a price point of view, technically it's definitely getting less strong. Silver. Silver and gold will always move together. Silver is doing exactly the same thing. RSI is starting to drop off here, even though the price, of course, is very strong. Silver has surprised everybody by its sudden strength. There could be a short squeeze. There's potential that Wall Street, specifically JP Morgan, got itself in trouble by selling too many silver futures on the short side, and now they have to cover those positions. If they actually had to liquidate all of those positions, it could look pretty grim for them. And once again, silver has the same technical divergence as gold does. Um, Another thing that's interesting to look at is the silver gold ratio. How many ounces of silver does it take to buy an ounce of gold? And historically, the way they come out of the ground is 16 to 1. And here, the price of silver was up to 70 to 1, which of course was at the high. It actually went above 70 at the high, and it's been decreasing steadily since September. Interesting timing here, and it is in this down channel, definitely very, very precise down channel. But from a technical point of view, there is once again negative divergence here, so there's potential that this trend will end, which could mean that gold could go higher and silver would break down. Same technical divergence in the MACD. So that's something to keep an eye on for those silver bulls. Silver can go down without gold going down. The other thing I like to do is I like to look at gold in different currencies. In this particular case, I look at it in the euro. In the euro, the gold chart looks very different, and there it is. This long-term trend is still very much intact. It could drop down to 1,000 euros and still be well within this trend. It has reversed when it hit that trend. It's a lot less far off than on the US side. Of course, that indicates that the US dollar is still very much oversold. And of course, that has changed over the last month and a half. There's definitely some US dollar bullishness, which is surprising everyone because everybody figures the US dollar is in so bad shape. I'm personally a US dollar buyer. Simply because I can't resist taking the other side of that trade. If everyone is on one side of a trade, then everyone knows. And if everyone knows, something else will happen. That's just the way the market works. Market never does what the majority of people think it should. VIX, the VIX volatility index, or the nervousness index, is way down. Nobody seems to be nervous about anything. And again, this is a scary trade. If nobody worries about anything, then I think something is going to happen. The VIX was way down in the 11, 12, 10 range in 2007. Nobody saw anything coming. If they had seen something coming, they would have taken out insurance. That's basically what this says, is nobody's taking out insurance against something bad happening. And if nobody takes out insurance, then we can be pretty sure that something bad is going to happen. Other things I am looking at, of course, there's the CBR. I don't want to look at that. Just look at the indexes itself. Here's an interesting thing that happened. I drew this trend line quite a while ago. This is the New York Composite, and the uptrend was penetrated right here, which does happen once in a while. This is not a very strong line, but what happened here is it got penetrated, it went back up, but it didn't penetrate the upside of it again, so it bounced off the bottom of this trend line. Very, very interesting move. The other thing that of course happened is that even though there's a higher high on the price side, there is not a higher high on the RSI side. So once again, technical divergence potentially flagging a problem. But no other indicator is showing this as of yet, so I don't know exactly what to make of this. The S&P does exactly the same thing, another technical divergence there, and we shall see what will happen. There is some pretty serious talk that the first quarter to second quarter of 2011 could be pretty ugly. There's a lot of things that basically come to a halt at that point. Things are running out of steam. Stimulus packages are running out of steam, and this everlasting belief that the Fed and the central banks can get us out of this by spending money, that you can basically get out of debt by spending money. People are starting to say, now wait a minute, this isn't working, because people still don't have jobs and houses still being foreclosed upon. Australian dollar, probably the most premier risk currency. Potential head and shoulders here. This would of course flag problems in China, because Australia is the major resource exporter to China. So if the Australian dollar is in trouble, then that basically would mean the Chinese are not buying as much as they used to anymore. There's a divergence here as well. And if they're not buying as much in Australia, then that basically means they're not going to make as many goods. Could lead to a slowdown. And the Chinese bubble is gigantic. It is way beyond anything else on this planet. Once it bursts, and it will burst eventually, it will be ugly. So something to keep an eye on. The Australian is a way to measure what's really going on in China, because obviously we don't know what is really going on in there. Even their finance minister, I don't remember who he was, but commented that all of their statistics are purely made up, that they have no basis in reality. So the Chinese just come up with numbers, and the world says, "Hey, this is great. There's no problem." Well, this is one place to look at to see whether there is a problem. Um, so that's about it. Uranium continues to go up. That was that other thing that I was looking at. This one here, the price of uranium is now nearly at $62. It was down in the 40s for a long time, and then it had this giant run up to 60. That's basically China and India buying uranium now. The Soviet Union, sorry, Russia has announced that they're no longer going to sell off old missile uranium by 2013, and therefore powers that have massive investments in nuclear power plants are starting to buy uranium in the open market, which is very good for uranium stocks. I've showed these before. The run up in some of these is massive. Probably the most premier company would be Cameco, because Cameco is one of the biggest uranium producers in the world. It's located in Saskatchewan, Canada, and it just keeps going up. I bought into Cameco somewhere down here on 24, and it's run to 40. That's a double in less than 6 months. That's nice. So uranium is definitely one of the commodities that is going, simply because countries need it. Countries need to have the power. They can live with a lot of other things, but they cannot turn the lights off. And uranium is the only way to create that much power, which China and India will need for the future. So bullish on uranium. I still do like natural gas, and else than that, I do like the US dollar, simply because everyone else hates it. It's not going to be a fast trade, but I believe that there is lots of upside on the US dollar, just because everybody's shorted it. That's all I have for today. Good luck next week trading, and all the best.